Hello, everyone. Thank you for joining today's webinar. This will be on the new world of sales tax after the U.S. Supreme Court decision. Today's program will be presented by Barry Horowitz, partner, Stephen Passagia, manager, and Lady McNair, lead at Wooden Smith & Brown. Before we begin, I have a few notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Barry, Stephen, and Lady.
Good afternoon, everyone.
Good afternoon.
Hello.
And just to let everyone know, we are having technical difficulties with the internet in the building in Princeton, so if something happens, just bear with us. Good afternoon, everyone, again. So prior to last summer, everyone thought that SALT was a seasoning. After the repeal of state and local tax deduction by the 2017 Federal Tax Act in December, SALT was in everybody's mind. People talking about how much extra tax they would pay because of the loss of the state and local deduction. And everybody thought, suddenly SALT came out, newspapers were printing articles on SALT, and it was coming all over the place. And now the Wayfair decision really has everybody on their mind. It's thrown the state, the world of SALT upside down now. It has only been 1 week. There have been writings, articles, and webinars all over the place regarding what's happening, and we're going to hopefully take you through the court case and what we can help you with and what we should be planning for in the future, because will be an ongoing discussion for the entire year of the change with the Wayfair case. States and taxpayers are trying to figure out what to do, and hopefully we will give you some insight on what to do. So just some background, and we're just going to be talking. I'm going to turn it over to Steve Passagia, who's an attorney, to discuss what the case was, what the Supreme Court decision was, and what we're going on. Lady, we're going to bring you through a lot of different scenarios, and then we're going to talk upon what we have to do in order to comply and figure out how your business can work on this. So with that, I'm going to throw it over to Steve and just talk about the difference in Quill, which was the old law, Bellows Hess, which has been law for many years, and what this new Wayfair case has done in the state and local scenario. Steve?
Thanks a lot, Barry. So just to start to give you a background on the prevailing standard until last week and moving forward, just to quickly address the precedent, which was established by the National Bellows Hess case, which was against the state of Illinois in 1967, and then followed up by the Quill case, which has been the prevailing law for the past 25 years. So essentially, this is about, what's the standard of nexus that needs to be established in order to have the state to be able to levy sales tax against the taxpayer. In 1967, the case involved a mail order retailer, which is basically the precursor to, I think, a lot of the modern e-commerce retailers that you see today, who had no physical presence in the state and shipped orders via a common carrier, with the court establishing that under the Commerce Clause, states would be prohibited from imposing collection obligations on out-of-state sellers that lacked physical presence. This was further re-examined in 1992 with the Quill case. That would be the business furniture supplier. Again, similar facts. The state at issue was North Dakota instead of Illinois at this time, in which case, again, the absence of property and payroll, and only the use of catalogs and flyers, telephone calls, essentially solicitation that generated those sales into the state. With the court, again, upholding that law, the seller must have some form of physical presence within that state. That key quote, the continuing value of a black line rule in this area and doctrine and principles stare decisis. This will come up for two key reasons when we talk about Wayfair. I mean, both the establishment of a bright line test, which I think is a big reason why the court took the case in Wayfair in order to establish a clear threshold that was simple and easy to follow, as well as going against those very principles of stare decisis when they did it to that Wayfair decision. I mean, the key aspects of the Quill, up until last week, were that because of the Dormant Commerce Clause and in the interest of interstate commerce, physical presence was considered to be that bright line area in order to establish comfort for retailers to understand whether or not they would be subject to sales and use tax based on their activity. In the preceding 25 years since then, with the increasing establishment of e-commerce and internet-based businesses, and just the changing moving away from brick and mortar type businesses to more internet-based businesses, I think that bright line is further faded away in light of the 21st century operations of business.
And here's our first polling question.
Would sales tax nexus be created under Quill if the company had no physical connection with the state?
We're going to give it a few more seconds as the polls are still coming in. All right, we're going to go ahead and close the poll.
And Steve, one thing we should just again reiterate, this is sales tax, not corporate nexus right now. We're not talking about filing income tax returns in the state. We're just dealing with sales tax. That's what Quill was about, and that's what Wayfair is about.
Right.
But we expect more coming up on presence in the state now, bringing in corporate nexus or partnership nexus or individual nexus based upon companies doing it. So again, let's concentrate on the sales tax area because that's the first thing we have to deal with.
Exactly. And it's like the majority of you are listening. The answer was indeed no until Quill without physical connection, which, I think for those of the clients and the businesses that are on the phone, that's just been the general understanding. If I'm not operating in the state, if I don't have an employee or if I don't have some sort of physical presence, then there's no obligation to collect or remit largely.
And Steve, again, Quill and Lady, Quill was before the internet was even invented.
Right.
Exactly.
So now we have the internet. Quill was beforehand. The internet is now there. It's anybody selling to a state by Federal Express, by common carrier going in. So it could be somebody selling parts over the phone or whatever else. It doesn't have to just be an internet seller doing this. So just want to reiterate that also.
Okay, so all right, let's get down to it and talk about the Wayfair decision itself and what's now the new economic nexus standard for sales tax purposes. So the Wayfair decision itself was 5-4, notable for being now retiring Justice Kennedy's last opinion before he leaves the court. Which was joined by some interesting facts about it was that it really didn't divide on conservative and liberal lines. And you really saw a disparity, and another key aspect is that two of the justices involved, both Kennedy and Thomas, went against their own decision in Quill. They both voted in favor of Quill of physical presence back in '92 and admitted as such that it was an incorrect decision. And despite the 4-member dissent, everyone was in agreement that physical presence was the incorrect standard that should be applied for sales tax purposes. With the dissent only really being rooted in, I think, what's been longstanding and is mere reason for this 25-year delay, that there was awaiting Congress to make the law, and it did not. So by overturning Quill and by establishing the physical presence is an inappropriate standard, and the rather principles of economic nexus should control, pretty much summarizes the main impact of the case and the outcome of that. And we'll talk a little bit about that later. Is that the court remanded the case to the South Dakota Supreme Court to work out. The main takeaway is that we can definitively say physical presence was the only constitutional aspect that the case dealt with in particular, and that they came down on as not being no longer applicable. Though they spoke in strong support of South Dakota's law and that they strongly believe that should serve as the model. I think you're seeing a lot of states now that are quick to adopt that model. They did not conclusively determine that is the constitutional model that's going to meet, and that model is going to meet any sort of commerce clause-based far as in their simplicity and applicability of that law, is that they were members of the SSUTA. They were members of a 20-state consortium that provides uniform laws across the board, and that really making an emphasis on the ease and the bright line ability, you could say, of the law that was established. Basically, and coming away from that too, the court stated in Wayfair that not just economic nexus, but substantial virtual connections or virtual nexus. I mean, it was the new phrase that was really introduced into the discussions, I think, going forward when it comes to a remote seller, an internet-based retailer, or otherwise, when evaluating the laws that are, in play and that the states are now rushing in to follow suit.
Right. And this is Lady. I'm just going to go really quickly here. I thought it was interesting. This is exciting times for sales tax, and particularly myself. But my favorite part of the case was that when it was noted that Quill was creating tax shelters for these out-of-state sellers, I find that to be so interesting. As we all know, the way that we do business obviously has evolved tremendously since 20, 30 years ago. However, the laws or the statutes have remained the same. And what basically Quill said that the physical presence what Wayfair case said that Quill, the physical presence decided as the Quill case is unsound and incorrect interpretation of Commerce Clause, as it was creating unfair and unjust marketplace misrepresentation for, and it was favoring remote sellers versus sellers in the state. So I thought that was my favorite part of the case. Sorry to interrupt.
No, not at all. And I think in the wake of Wayfair, the question would be, okay, we have a model with South Dakota, but then what is the resulting constitutional standard going forward? Or what's the standard that courts are going to look at, and the businesses and tax counsel and whatnot should be evaluating when a certain state wants to impose similarly situated economic nexus-based laws for sales tax purposes? And that is the complete auto transit v. Brady test. So it's a four-pronged test that was established in a 1977 case, and really this is going to be the standard, rather than Quill, rather than physical presence going forward, that when these laws are going to be challenged in the future, they'll look to. And those four prongs being, does that the court will sustain a tax so long as it, 1, applies to an activity with substantial nexus, 2, is fairly apportioned, 3, does not discriminate against interstate commerce, and 4, is fairly related to the services the state provides. And that meeting this test will allow the state's law at issue to meet the requirements of the Commerce Clause.
Right. So to summarize, it's going to be an exciting time for us, right?
Right.
And confusing time.
There was the Marketplace Fairness Act. There's some acts out there. We've heard some federal legislators, some senators and congressmen talk about this now. Do you think we'll get anything from Congress? I doubt it, because the way Congress works,
right,
it's not going to do it.
Right. Though there is more of a push, so there's discussions in the marketplace, there's more of a push for Congress to do something, because whereas before they would have been seen as implementing a tax, now they can be seen as, quote, saving the day and working things out to establish some more multi-state applicable standards that would be, apply universally and to make things more simple. And that's really what,
You're going to get some pushback, like New Hampshire, right, where they have no sales tax. So you're going to get some pushback from those states. There's only 5 of them where they've made it so easy for their taxpayers to not have to collect and remit sales tax. And now they're saying, well, they're going to have to be responsible doing that in every other state. So it's going to be exciting. It's just time for sure.
And since there's so many small businesses in the United States and mom and pop operations working at a home, this is certainly going to be an area. I know this certainly may affect the eBay model now, where people are selling over the internet, individuals selling products or whatever else.
They issued their own individual response, and when this law, when Wayfair was decided.
And they were the first ones they wanted to sue. Yeah, they were the first ones. So again, stuff like eBay or something like that, this is all, again, Amazon was a leader in pushing for the sales tax implementation. The push for getting sales tax being collected in various states now, and now it's just reaching over to the other retailers now.
Yeah.
And yeah, so in summary, I mean, Wayfair held that physical presence is no longer required as part of the necessary interpretation for determining whether or not the substantial nexus requirement under complete auto transit is satisfied. And now, although Quill is overruled, I mean, there's still a Commerce Clause analysis to be made. I mean, I think one of the things, one of the phrases I heard was, this isn't a blank check to the states. It doesn't mean they can apply any and every kind of law. And we're going to discuss that a little bit later, because there are a number of different variations on some of these economic nexus laws, like notice and reporting requirements and click-through nexus, and things where that are, quite frankly, question marks as far as whether or not they will be seen as constitutional as this bright line test of $100,000 worth of sales, 200 or more transactions.
And this reminds me of when the click-through nexus got implemented a while ago, and everyone got so excited. And however, I didn't see a lot of our clients, which are the small to mid-sized businesses, kind of following and complying to the requirements of click-through nexus. So it's going to be interesting to see how the taxpayers are going to, or the companies are going to react to this new requirement of economic nexus.
And I think you're going to see the attitudes would be from largely conservative, I think, with a lot of the states, because, you know, do I rather want to go with a model that's been, you know, approved of by the court and that's already clearly established, and that isn't unfavorable. I mean, $100,000 sales threshold, it's lower than typical economic nexus thresholds for income tax purposes, and that 200 transaction threshold isn't very sizable either.
Right.
But nevertheless, note that every state's nexus law, you know, will still nevertheless be analyzed in light of the Commerce Clause, and to the extent that there are certain states that decide to deviate from that or allow some of their pre-existing laws, like say Colorado, if they establish their own $100,000 threshold and they maintain their notice and reporting requirements, right, like alongside, well, now it's not so simple anymore. Now it's deviating away from what the case decided, and it gives room to be challenged in litigation.
But I wonder if Colorado is going to change it from reporting to actually having to be compliant. So that's very interesting.
Yeah, one of the other issues that's coming up is the smaller states in population are jumping in the bandwagon with these requirements for the sales and or transactions. While I would call the big five states, New York, California, Florida, Texas, and Illinois, we're going to see what they end up doing, because they have sophisticated tax people up there, and they're going to be writing laws, and we're going to see what they come up with, and we're going to see if they may have to even back down on what their law says, since they cover a lot of different areas that other states have never even touched on. So again, this is all a work in progress, and like I said, it's an exciting time, and there's a lot of things that have to be done for our clients and for everybody across the board. But again, slow and steady is the best way, because rushing into something may not be what the right thing to do is.
Right. I think we can go to the question too.
And here is the second polling question. What Supreme Court cases test presently controls in the wake of Wayfair as to whether a state's nexus law is constitutional? We'll give it a few more seconds as the polls are still coming in. All right, we're going to go ahead and close the poll.
Okay. Most people thought Wayfair. It is complete auto transit v. Brady, by the way. Again, that four-pronged test. Wayfair was the antiquated. You know, that was what was being applied. Now going forward, again, all future state laws that are challenged, state sales tax nexus laws that are challenged, will need to be evaluated under that four-pronged test. Wayfair impact and predictions.
I can go here.
Sure.
Go ahead.
So I'll give you a little bit of a break. So Steve and I will rotate between each other. So Wayfair impact and predictions. Obviously, as we know, is going to create some headaches for the small businesses. We put some slides together just to give you guys a general idea of what some of the states are doing currently. but obviously, we can discuss in detail at a later time what they specifically are doing. So we have currently 45 states that include sales tax. 31 out of those states have some nexus in provisions that include or exclude physical nexus, which would be economic nexus or click-through nexus. And obviously, we've included a slide that outlines those states. 60 states have laws presently crafted similar to South Dakota, which means that if you have over a certain amount of sales in the state or transactions, then obviously you have met the requirements and you have nexus in the state. And then we have those 5 states, which I always love to hear when clients say, oh, well, I'm doing business in Delaware, Oregon, or New Hampshire. What should I do? And I say nothing, right? So we have the 5 states that have no sales tax imposition. However, it's going to be interesting to see these 5 states go against what was decided in Quill. Then also what's interesting here too, we have all these nexus requirements that are being drafted, and now it's a good time to kind of look at taxability of the product. So what does that mean? Once nexus is established, so the next step would be is the revenue stream subject to sales tax or not? So that's an important step in becoming compliant post Wayfair decision. There's a nice slide in here that Steve put together for us that kind of presents all the states with some type of whether physical nexus or economic nexus or a click-through nexus. Winners and losers. This is my favorite slide, I would say. So obviously, it's very clear that states are the winners. The court took that into consideration when they made the decision. They felt that the states are losing a significant amount of revenue from having these large online retailer not collect the sales tax in their state. So obviously, states are the big winners here.
And lady, want to just jump in and, there's always been, every state has a use tax line that says if you bought something and bought it to report it. This is now forcing that use tax to become a sales tax. Exactly. Nobody reports. So
exactly.
It's on the book. So everybody says, oh, this is brand new. It's not brand new.
It's always been there, but then you actually really accrue use tax. I mean, I know a couple of people that do it and report it in their 1040s, but not everyone does.
And the other thing we just make mention, again, I think we may have said it before, this has to do with tangible personal property, a Wayfair case, with services and other things, always were taxable in states, and we always have to deal with that. So basically now everything now is covered.
It the old product.
Yeah. So now everything is covered by sales tax, basically. They brought in everything now.
Right.
So
well, and also too, I think people would be surprised that, with the large businesses, many large businesses actually lobbied for the decision that was made in Wayfair, because oftentimes when they were pulled into sales and use tax audits, it was really use taxes that they were they ended up being liable for, and just because of the difficulty of tracking which of their expenses were subject to sales tax
compliance process. Right.
Exactly.
So it's much more burdensome. So they decided to just collect the sales tax. Losers. Obviously, the small e-commerce businesses. I have a lot of clients who are startups or small businesses who do not have the expertise in house or the tools to be able to comply and file the returns. So I feel the pain that they're going to have to go through for sure. Consumers, I myself don't really care for the sales tax being imposed, because I always feel like, I never really looked at the sales tax as making a difference whether I bought an item or not. But obviously, I know Barry does. So yes, so I know he's going to be affected by it. And the states or the businesses where located in the states where there's no sales tax, like I said, New Hampshire, Oregon. Obviously now they never had to file a sales tax return. Now they're going to have to, right? Or they're going to learn how to. They're going to need to have the resources and the software tools to be able to do that.
And it's interesting. Quoting
quoting
the governor of New Hampshire, stating that it will erect every possible constitutionally permissible legal and procedural hurdle to prevent other states from collecting.
I saw that.
And so here you're going to start seeing states try to force the other way back. So it's very interesting. We're going to have this battle again. So those are some small states, but you're going to have a lot of politics in here.
Yeah, definitely. Like I said, it's going to be exciting times, and I just can't wait to see what is going to come from this. We're at slide 21, unintended consequences, right? So we're going to see some changes made in a state like Colorado where reporting was required up to currently. So we're going to see a handful of states going back and trying to make changes to their statutes and regulations and apply Wayfair to their rules and impose economic nexus too. So it's going to be, you know, and like Barry said, we want to go slowly. I don't want anyone to be alarmed and to go, oh, you know, thinking, oh my God, I have to file in every state. But in the next couple of months, we're going to find out how the states are really treating or what the states are doing. But if we have to take a wild guess, right, we all in agreement that the states are going to try to impose some type of similar nexus requirements as they want the revenue.
It's also from a practical perspective too, is that why not institute a simple bright line threshold and do what's safe and what's constitutionally been, strongly supported. I want to say that is the constitutional framework because the court was careful not to come down definitive. I mean, they were definitively against physical presence. They were not definitive in that this is the gold standard, but it's essentially the de facto gold standard. And yeah, that's the big question with a lot of these notice and reporting requirement type states. Is it worth having multiple ways to get at you? Because what that does is make things more complicated, not less complicated, and opens yourself up to potential constitutional challenges. So with a state like Colorado, why do all that tracking and why make all that compliance and notice and reporting requirements when they could just set a $100,000, 200 transaction threshold?
Right, exactly. And you know, I had a lot of my clients who decided to forego on Colorado for the reporting requirements, but then once they actually imposed a fine in Colorado for not doing so, that they were more open to registering there. But then you have other states where there is no fine for not being compliant and reporting the sales into the state or your customers to the state.
And while the courts have upheld notice and reporting requirements as being legitimately constitutional, click-through, agency, affiliate, all these other different economic type nexus standards, the court was silent about. So again, it leaves a lot of room for potential. I think
it all stands, right? I don't think anything will change there for now, for sure, on the clicks of nexus and yeah. So, okay. Do you want to talk about the accounting implementation? Okay.
Sure. Yeah, definitely an important nuance. I know EY released an article several days ago about this, and it was one of the first things that was discussed, in the wake of the case on June 21st, for your auditors out there, the implications of ASC 450. So from an accounting perspective, whether or not for financial statement recognition purposes, is a disclosure necessary? So for those that are not auditing focused, the ASC 450 provides for loss contingencies related to indirect taxes, or I should say that include indirect taxes, that there's categorized by likelihood of occurrence. So I think auditors would want to take interest in, the time that should be taken right now from either whether it's analyzing your nexus footprint, your sales by state, what states you're doing business in, where you think you might trigger these sales tax responsibilities, and how far they may go back. And, as far as how that then interrelates for financial statement purposes as to what you need to disclose or not. I think a careful eye will, need to be taken to state-specific legislation, how they apply retroactivity, because that potential retroactivity will impact, again, the necessity and the size of the contingencies that need to be taken that would be at issue.
Right. And Steve, not only does this affect accounting, it's also going to affect mergers and acquisitions, because now you're going to have the issue coming up where due diligence, somebody coming in looking at sales tax, and now it's at the forefront, looking backwards if you're buying a retailer or somebody else saying, have you collected sales tax in essence on the books now of many states? This could come into much bigger play.
Yeah, definitely for sure. I think we can go to polling question.
And here is our third polling question. How many states presently have legislation on their books for remote retailers? All right, we're going to go ahead and close the poll.
Yeah, so yeah, everybody got it. 31 indeed is the correct answer. For those states, and again, it's good to keep those states in mind because what they're indicating is that they've already gone beyond Quill independently ahead of this case to establish their own sales tax nexus laws that already provide. So the groundwork's already in play, and they're already going to be at the ready to move forward in light of the Wayfair decision.
So we can move along. As Steve and Barry and myself noted before, there are obviously a handful of states that have already imposed an economic nexus. We've listed them on slide 25. Connecticut, Hawaii, Kentucky, and Oklahoma, they're fairly new. They go live on July 1st. So obviously we want to make sure that we are compliant with those states. And down a little bit further, we'll discuss on what needs to be done. When you have a state that imposes economic nexus, what should you do?
And I was just going to notice that is in the typo. So while Kentucky actually has a $500,000 threshold, so that's why it's not in that 100 to 200 transactions. They just have a straightaway $500,000 threshold as is. But yeah, those 4 states in particular are ready to go live next week.
Right.
So in looking at the pool of states at issue, those should be, I would say, top priority.
Right. And I'm sure everyone was waiting on the Wayfair decision before they decided to do anything in those states. So as you go down the slides here, obviously there's Iowa, and there's the requirements in Iowa, $100,000 RVU and 200 transaction limit. And then the similar thing in Louisiana, Vermont, North Dakota. And obviously you guys can kind of go through this on your own, but it's the same type of threshold, I would say, as the South Dakota case. What's going to be interesting is, like Barry said, the bigger states, what if Texas and Illinois and California are going to jail post Wayfair? So excited to see what will come out in those states.
And I think, from both a retroactivity standpoint as well as bringing together some of the topics we've talked about. So Iowa, for instance, they're also maintaining their marketplace provider nexus alongside that economic threshold. So they're maintaining 2 different types of methodologies to apply. Louisiana, they're saying that tax periods beginning on or after the decision in Wayfair. So you don't need to worry about looking back prior to June 21st. And, I wish I could say that there's going to be some general applicability across all the states, but it really needs to be a state-by-state evaluation as far as anticipating and estimating out potential liability.
For instance, Vermont says go back retroactively. Look at the back transactions had. Some states may go forward. Some states may go at a different point during the year. So again, we all have to monitor what this different reasoning is. And again, we'll just go in. I have a state where I make 200 sales at $5 each. Do I register or not? So again, those are things that we're going to look at on a practicality on a company-wide basis.
And I just want to know, we are getting questions coming in, and we are definitely setting aside time, and we'll go through that question by question at the end.
Yeah, definitely. I mean, that was a good point, Steve, that you brought in. It's important that we address when it becomes effective, and do you have to look retroactive or not, because that will kind of we'll be able to help our clients or taxpayers will know how to deal with a certain state going forward. Do they need to go back and do VDA possibly, or should it just go forward? So, but that was a great point.
And many states may come up with the whole procedure on this stuff. I think the states are doing it very slowly because I don't know if half the states can even take on a lot of registration at one time. So again, which everybody's monitoring, and slow and steady is a much better course.
As far as the sole practitioner community is concerned, I know that there's a lot of at least indirect pressure to states to not apply retroactivity, and then that's only is in support of the Wayfair decision. I mean, the point of the reason why Wayfair was decided positively, and one of the key markers was the fact that there wasn't retroactivity being applied in the South Dakota law. So I think there's a push there. I think we're seeing a lack of retroactivity in the legislation that's been rushed to market in the past week. So again, at the same time, the case was also silent about it. So the states have that in their purview, but I think there's at least a soft push to not be too punitive to retailers that'll get pulled in by this law.
So which leads us to the slide discussing what actions can we take or can be taken presently to address the Wayfair decision. I think this is a slide or that the slides coming up are the ones that are most important to everyone on the call is, okay, now I understand what happened in Wayfair. What do I do going forward? How do I minimize my sales tax liability or presence? And what are some recommendations? So obviously, companies should review sales by state transaction activity in the state to see if it meets the South Dakota threshold. But going back to Barry's point, you may have 200 transactions, but at a very low dollar amount, it becomes more of a business decision whether you should register or not. The law obviously requires you to register there to meet that threshold, but then we always recommend our clients to kind of make a business decision there. Forecast potential liability costs, right? So this is something that I always tell my clients. When you make a decision to register or not, just forecast what that potentially could cause you in the future. Take into consideration that you may sell at one point, or you may get audited at one point. So just kind of forecast what this potential liability means, and are you comfortable with it? An important part of this whole process is review the taxability of the product, right? So if you have a state where we meet the thresholds or go up 200 transactions or the $100,000 revenue, you may have an access in the state, but your product may not be subject to sales tax, may be exempt. So what should a company do? And it's all going to depend on the type of state that you're doing business. If it's a state like Texas, you may not have to file a sales tax return because they don't require it. If it's a state like California, you would have to file a zero sales tax return. So again, it all depends on state per state basis. As we sit here today, we're only saying generalize, and we talked about Quill and we talked about Wayfair, but when it comes to states, they all do things differently. So there are similarities, but it all depends what the state is going to how the state is going to address it. Review potential sales tax compliance solutions. So this is one of the biggest issues that I see for small companies, is to be able to afford the sales tax compliance process. Obviously, they don't have the expertise in-house, so I can see this being the biggest challenge for the smaller businesses, but also for the mid-size too. It's different filing in 1 or 2 states versus filing in all states and local, right? So I know I hate to file compliance in Louisiana, so that alone creates a big nightmare.
We also have to, in the compliance, just talk about, localities also we have to deal with also. All the locals.
Exactly. I mean,
thousands of them in the state.
Right. And if they follow the same model that Alabama follows, where you can file one form and it's going to include the local sales tax, it would be perfect. But I haven't seen anything in Louisiana that has similar things, and I don't think it will happen because parishes are pretty vicious there. So it's going to be a total nightmare. For smaller businesses and mid-sized businesses. Company consideration, you want to go?
Sure. I mean, I think there needs to be a focus too on, one of the things that kind of like from a 10,000-foot view that I've, recommended over the past week too is, looking at your sales by state. So what states are at issue and what state you sell in excess of $100,000 worth of sales, and then what's the nature of those revenue streams and how the taxability of them in those states to see what's at issue. And the red flag those states, as we previously indicated, those 4 states, Connecticut, Kentucky, and whatnot, whose economic nexus laws are being triggered July 1st. It's interesting. I know we jumped over it, but even South Dakota itself, the case is still on remand and the injunction stands. So if people are thinking, oh my God, do I need to collect or remit for South Dakota? That must be instantaneous. There's still, states are treating this on an individual basis to work these things out. That being said, it's easy to, we're providing you like those states that have that methodology already in place. Those should be the at least yellow flag states. Those should take top priority. Review how significant your presence is in that state. If you, I know it's not to jump ahead and answer a question that we received, but I know people are engaged in certain sorts of transactions that are non-taxable or exempt in a given state. Oh, is this exempt across the board? Potentially not. So, if you're used to only following in, or being present in traditionally for sales and use tax purposes 1 or 2 states, you need to look at the individual taxability in the state in which nexus is triggered to make sure that exemption carries over, or that it is is or is not taxable.
Right, and you do, I'm sorry to cut you off, Steve, but I just want to add in here, not only do you need to do that, you also have to have a software tool that captures the taxability of a product. Because once you issue an order and invoice to the customer, the system needs to know whether it's subject to sales tax or not. So for my e-commerce clients that sell about 10 or 20 different products, it's important to have that system in place with a different taxability, and also that the zip codes and the sales tax rate based on zip codes. So it's definitely going to be fun for sure.
And just for those of you that have, their larger structures or maybe that aren't used to paying sales tax, and note that you have multiple entities in your structure, you're used to filing consolidated or combined return, and you think that, okay, well, maybe I will be subject to Nexus. I'm just going to be filing one return. Sales and use tax is unique in that it goes by an entity basis. So if you have, a subsidiary that sells revenue stream A and another subsidiary that sells revenue stream B, you need to look at those entities individually, even if we're talking single member LLCs, to see whether or not they individually are triggering Nexus, and is the what is the individual taxability or the respective taxability of what they sell.
Which means we may have to look at restructuring clients and how they're structured, and maybe merge companies together or whatever else and come up with one filing.
As of before, sales tax was not one of those things that they considered to do mergers and acquisitions, but lately it's definitely become, one of the criteria of things that companies look at. Company departments involved. Obviously, who should be involved? This is a great question, I think, for everyone on the phone that is on the industry side. My favorite one when I worked in the industry was IT. The reason why, because IT can do wonders for you, and they can help you with giving you the right reports, set up the tax codes, the taxability of products, the correct zip codes, and all the other good stuff. If that process or the implementation with the IT does not go well, it could create a total nightmare and a big liability for you. So, if I had to pick, IT is definitely one of my favorites. But obviously, internal auditing, tax is also important, and third-party consultants. I have clients who want to set things up right from the beginning. They say, well, we'll incur the cost because I want to make sure we do things correctly. And then I have some who wait, they do things the best they know, and then they come across a nightmare. So just be aware that planning ahead, it always pays off, but then it always has to be a business decision. It has to make sense for all parties involved.
And just to jump in, and why do we say income franchise, for instance, or why are we talking about registered agents? Income franchise in particular, you trigger sales and use tax Nexus, and then let's say you have to register your business. That could have income tax implications. There are certain laws in place for income tax purposes where just registering to do business in a state obligates you now to file an income tax return as well. Or vice versa. If you're already filing income tax and were under the impression you weren't subject to sales tax, to look at where you're already registered. And then also, if you need to register, oftentimes that requires a registered agent, whether it's CT Corp or a similarly situated company, in order to establish presence to receive service or process. Accounts payable is in there as well, is because if you haven't thought about it before, get to thinking about how you're going to present these taxable services, and if you sell a mix of the two, whether or not you can itemize or enumerate those separately, depending upon the state, in order to not make everything that you're selling taxable, but that you properly present what's being sold in a respective state in order that you're collecting the right amount of tax.
Right. And I think one of my most favorite slides in here is how Rhythm can assist. So what can we do to assist companies become compliant post Wayfair? What are some of our recommendations or some of the things that we can help companies or our clients or even internally with? Nexus study is the first one, right? Before, when Quo established that physical presence was necessary and needed, I could jump on a call and say, what is your activity in the state? And it would be easy enough to say, well, listen, you have employees, so you have Nexus, right? It was easy to say, you're physically in the state, you have Nexus. Now it's it became much more complicated. Why? Because we have to look at each state separately. We have to see what the threshold is. We have to do an actual study to figure out if it's applicable or not. Product code review. So this is also one of my favorites. The reason is because I've seen companies where this portion of it was done incorrectly, and it just things didn't go well during audit. So it's important to understand that the way that the product codes are set up from the beginning, and how they relate to a software tool such as Avalara, Vertex, and the implementation is done correctly, that's how the system will know when it is to collect sales tax. If that part of it is missing, then it created a big liability for sales tax liability. Revenue stream taxability analysis. Obviously, this goes back to what we said initially. This is also important because you may have nexus, but your products are not subject to sales tax. So then further research is needed to establish whether the state requires zero tax return or not. Multi-state sales tax compliance. So Wyndham has partnered with Avalara, and it's been a couple of years now, where we provide sales tax compliance services through Avalara. We work together really closely to provide our clients compliance services. So this is something that we put in place a couple of years ago, and we're pretty excited at how the process, and it's been going really well with our current clients. So obviously there has to be a scale of economics in regards to the clients that we partner with and work with Avalara, but Wyndham is more than happy to help our clients with the compliance process of it. And then review internal controls, right? So this always is something that companies should do. Internal controls is something that should be done on yearly or a couple of years, and just to make sure that for sales tax purposes, there's really no open items or no sales tax liability that is sitting there that a potential audit should discover. And then we can move along to the polling question number 4.
And here's our 4th polling question. How should companies address Wayfair's impact on their business? We're going to give it a few more seconds as the polls are still coming in. We're going to go ahead and close the poll.
Was you already saying the seat tax advisor got it?
So you've been listening very nicely.
Exactly right. I just find it interesting, it's like 2% say higher indirect tax staff to beef up the tax department. Yeah, interesting. Okay.
Well, we're always here for y'all.
That's right. And then just the last question, outstanding question. I'm sorry, go ahead, Frank.
Yeah, outstanding questions remaining after Wayfair. So
yeah, there's definitely some blank areas, some to be continued, some to be decided. In particular, I know that it's come up is then how do you define an individualized transaction? So, I've already heard questions and people bringing up, what constitutes one of these 200 transactions? And some of the new legislation that's being introduced is already doing that, like sales delivered directly into the state, I believe is how Iowa phrased it. And or sales are destined for cited to the state. I think it's on New Jersey's legislature. But because of that being the rote language, more often than not, they're looking to, well, what constitutes individual transaction? For instance, if I'm billing something, software as a service, over the course of a year, so that's 12 monthly billings. Is that really one transaction or is it 12? Or if I'm dealing with the same customer through the entirety of the year, is that one transaction or multiple? I think a close eye will need to be looked to as to how that state defines it. I'm sure that'll pop up in an FAQ or whatnot, depending on for each respective state, because that may be the difference between triggering nexus or not. Will the states levy retroactive liability? The South Dakota model certainly doesn't provide for it, and the court was in support of that. So I wouldn't put it against. I mean, already you have a handful of aggressive states that went beyond the Quill standard, and that's why there was a case to begin with. So the states aren't shy about maybe going beyond those bounds, depending upon how their state budgets require it. So that may be the case. If you trigger nexus midway through a year, now some states are already providing for this by having it be an annualized look back. So you look back at your activity for, say, 2017 in order to determine your 2018 nexus. Many states aren't. So if you hit that $100,000 threshold or that 200 transaction and it's October, are you on the hook for all the sales you made up until October, or is it as of that date of registration or as of that respective quarter? then also this one we feel a little more comfortable about. So do non-taxable or exempt sales contribute to that $100,000 threshold? So I have multiple revenue streams, some of which are taxable, some of which are not. And that's I'm only
The store doesn't deal with that. So it doesn't make a distinction. So I would say it doesn't matter whether it's exempt or not. Exempt sales will come into place when you decide whether you should register or not, assuming you have all zero.
And even looking at gross sales.
Right,
yeah.
right, exactly.
As the ultimate arbiter. So, and also too, even if you're not, what you're selling, as the lady referenced with regard to zero tax returns, even if you're not ultimately subject to, what you're selling is ultimately not subject to sales tax, because of the fact that you've triggered nexus and you have significant enough activity, would there still be a compliance obligation in place?
Right. And once again, we just want to reiterate, the case is being remanded back to the South Dakota court.
Right.
They have to write it, and I guarantee there will be eager state and local attorneys ready to rip apart their decision and ready to go back to court in not only South Dakota, but various states on this. Because I don't think it's an end game yet. But again, we're gearing up for registration, for filing, and whatever has to help clients get to this. With that, I think we're going to bring in some questions that we have out there. If we don't get to every question, if your email address is there, we will answer it back in writing to you.
Right, or just feel free to email.
Yeah, email us, and we will get an answer back to you.
And there was one other unanswered question, I think, with regard to international entities too, that I did want to just reference real quick before we jump in, is that how will this affect international, non-U.S. companies that are selling into the United States? The way in which the case was decided and the way in which it was looked upon was that this was interstate sales. So it was U.S. sellers selling to U.S. sellers. And so it talks about, foreign commerce clause, the import-export clause is potentially impacting internationally based sellers that, if they don't otherwise file an 1120, aren't otherwise having a permanent establishment, but nevertheless are selling enough of their goods remotely from their respective countries to trigger sales tax nexus. Still is yet to be sussed out, but something to keep an eye on, and maybe for more aggressive international planners to wait and see. So we're starting from the top here. We'll start at the top. Okay. So our first question was, we are New York based. We sell a financial data feed to large financial institutions and hedge funds. If a Connecticut firm enters into a contract with us for the purchase of this data delivered via an API, are you saying we now have to collect Connecticut state sales tax and report this in Connecticut?
Yeah, so what we're saying here is you potentially could have nexus in Connecticut. However, we're not saying whether the transaction itself is subject to sales tax or not. So that's to be determined, right? So there's two prongs to your question. Do you actually have nexus there, filing requirements? Because you may have, or you meet the sales threshold or the 200 threshold that there is, 200 transactions. And then the second prong is what you're providing in the state subject to sales tax or not, which is a tricky one. So that's to be determined at a later time.
And also because of the nature of the data, we would need to dig in to see how Connecticut treats the citing of the delivery of that data, because, as you said, it's delivered by an API. So there's definitely some nuances to your fact pattern that we have to look into with more detail.
Yeah.
Where can I go to research this topic per state? Most states are providing this on their DOR website, usually under there's a businesses tab. With regard to sales tax detail, most states, again, use that particular slided issue of those states that are already applying a South Dakota standard, and that'll be the site where you find the FAQs and where you find some of the follow-ups and some of the contact numbers. You have certain states too that are establishing their own, hotlines,
right?
For the Q&A on this as well.
So we're lucky enough we have an internal research tool that we use. Not internal, we subscribe to research tool. Obviously, not everyone, our clients or who is dialing in, has access to it, but online, that's a great answer.
Okay.
Are there any exempt products or services like medicines or educational fees? Well, again, something like that, and the stock answer is every state has its own rules on this. It might be taxable in one state, it may be exempt in another state, it may be for resale. So again, Every state we have to look at your customer base, see where you're shipping to, if they meet the threshold, and then see if that product would then fall into an exempt category or not.
Is business consulting considered a service in all states? Similarly, is software as a service considered a service in all states?
Right.
Right.
So they're both services, right? So the question is whether the services are subject to sales tax or not. So the way sales tax works is every state has a provision that says sales tax is imposed upon sale of PPP, which is tangible personal property, and certain enumerated taxable services. So if business consulting or SaaS falls within the imposition of sales tax, then obviously it would be subject to sales tax in the state. But that's something that needs, it's per state, it's different every state. It needs to be locked in research on state basis.
Okay. Next question. If sales are mainly to tax-exempt customers, will it be necessary to register and file zero returns? And the answer is we have to see what every state does. Every state, they're all implementing their own rules, and we have to see if the requirement or not asks you to file. Or again, as we said, as Lady said before, it's a business decision to see if you actually want to comply or not. One thing I always say, if you get the statute of limitations started correctly, it's much better down the road because something may pop up that you didn't realize was taxable or non-taxable.
One of the things that jumped out at me about your question is that you say it's a tax-exempt customer. Well, how are they tax-exempt? Sale for resale? Is this a governmental entity?
You have an exemption certificate.
Right.
Is an exemption certificate properly completed, right? So there's so many things that go into that.
So, yeah, and to your tax exemption certificate point, it's like, okay, so you may have ultimately no tax liability on the sales that are being provided. That still means you need to register, and you still potentially, and certainly that you need to collect those exemption certificates in order to substantiate that average challenges upon audit. If a company sells items at $100,000 or more a piece, but can't predict which state the customer will be in until the sale is made, do they wait to register until they meet the threshold in a state?
I mean, I would. That just becomes a business decision. I personally would, because you may not have a sale for a year or two, so then you would have to file zero tax returns. I would wait. I think some states, and we have to look at the language on state-for-state basis. Some states will say on annual basis if you exceed it. So that means, let's just for conversation's sake, let's say 2018. So you will do a review of your sales in December of 2018 or January 2019 and establish that you've met the criteria, and then you would register then. But again, every state is different, so you would have to kind of research and see what the requirements are.
And it's also very important to review your corporate records to make sure you haven't registered in states already and forgot about that.
Oh, that happens all the time.
It happens all the time where somebody is registered in a state, they forget about it, and then
we go and register them. I said, well, you already registered.
And that's even worse then, because then we have to start filing and remitting. Again, states are very happy to take your money. Just make sure we comply. And obviously, if you start to register after a fact, there are ways through voluntary disclosures, through working with penalty abatements, working with the various state authorities to get penalties abated and get you on the right filing.
Okay. Will the sales tax typically be only the state tax, or will the local sales tax be tracked and due? Yeah. I'll say, as a general rule, you can assume that the local sales tax will be tracked and due as well. I mean, there may be a push to simplify, as you had said, like with Alabama and other states, where they have one uniform rate for just remote retailers, but too soon to tell, but unlikely.
But New York has got 67 counties. New York wants their dollar.
Right. No, I haven't seen it in Louisiana and in Colorado, so it all depends what how they're going to deal with that.
And there's also an attitude in the case that you can depend upon systems like Avalara and software compliance to get to the right rate. So, for good or ill, the impression of the court and at least of the marketplace at this point is that the resources are there for you to get to the most accurate rate, which benefits the states, because then they can just say, well, as long as you're using the right software or doing the right legwork, it shouldn't be hard for you to get to the right tax amount.
Okay, if you have an online retailer selling via eBay based in New Jersey and selling to customers all over the country, what would you recommend to be the best approach? Look at every single state, see if they meet those thresholds, register, and start collecting, because eBay is, like I said, is one of these issues now where a lot of individuals will be having to remit tax to various jurisdictions there. But if your volume is enough, the dollar amount's enough, I think you're going to have to definitely
what
start
we're going to see is also, eBay, like Amazon, where they request to see all their vendors that use the platforms and make sales into the state. So it's important that they look into that.
Okay.
All right. Thank you for attending our webinar. Please remember to take a moment to complete the online survey. We will be sending out invites shortly for our next webinar. Thank you and have a great day.